Good morning, traders. Happy NFP day. Morning, Kay. Morning, Stel.
Good morning, everybody. Morning, Ryan. Morning, Stel.
How's everyone doing? All right?
We're good, mate. Waiting
Good.
for news.
Good morning.
Here he is. Here he is. Finally plugged his headphones in. You good, mate?
Happy NFP day.
Happy NFP day. Happy NFP day. Right.
Yeah.
Well, jobs is quite a big feature of today's show. Just looking at back at stuff. We'll start with some of the stuff that happened overnight. China have been touting easing some measures or easing some stuff for the property market over there, and we got some news on what they're going to be doing. Such things as they've got a rate limit for first-time buyers that's going to be abolished. They're going to be increasing or allowing property developers to increase leverage and that sort of thing. So pretty big moves in the China property market to get the ball rolling there again. Obviously coming on top of stuff they're going to be doing to help the economy when this COVID wave passes through. Moving on to Japan, and this is probably the biggest news overnight. We got some wages data from Japan, and a lot's been made of it in terms of real wage numbers. There you can see the average cash earnings, 0.5%, so up but a little bit lower than the 1.4 prior. And when you take that into account with inflation and everything, it's come out with a real wages of negative 3.8%, I think the number was. And a lot's been made of that number. But it's twofold. It highlights one aspect of why PM Kishida is pushing so hard for wage increases. But on the other side, you know, if wages are weak in real terms, the Bank of Japan are expecting inflation to fall this year. If they get big wage increases, it's going to put wages into positive territory. That's all well and good, but if, as the BOJ expect, inflation is to pull back, and as a lot of us here are expecting as well, wages turning positive is going to add a bit of inflationary pressure to the mix, and it's more of a domestic inflationary pressure rather than the imported inflationary pressure that Japan has been seeing a lot of. In the meantime, what that potentially means is that makes the Bank of Japan more likely to look towards tightening if inflation is now rising on the back of wages, which, as we know, is one of their big remits and reasons that they're looking for sustained wage growth before they even think about tightening. So we keep mentioning it, this new fiscal year and these wage negotiations to come. Don't ignore it. It could be a real big piece of the puzzle for Japan. It could mark a big shift if Kishida gets his big wage gains, and we see this trend in wages higher, although it's creeping, it is in the positive and has been for some months. We could finally be getting close to a big shift from the Bank of Japan. Obviously, lots of water to go under the bridge until then, but when you're trading fundamentals like this, you take the little clues month to month, week to week, and you build the picture, and that gives you insight of when potentially to jump into a trade or start building a trade for the longer term. And on top of that, just keep an eye out on Monday, because we get Tokyo CPI. So that's going to come out early Monday morning, I believe. So that's potentially going to be a big number for the yen as well. Coming across to the UK and or Ireland rather. No, it's UK. Foreign Minister cleverly says we are moving pretty fast on resolving the Northern Ireland Protocol. This is that bubbling situation going on with Brexit. What I feel at the moment is that we may get some headlines saying that they finally found a resolution for the Northern Ireland Protocol. I'm not sure it's going to be too big for the pound outside of maybe a quick knee-jerk reaction. There's far bigger fish to fry these days than that thing there. But keep an eye out in case we do get a confirmation headline that something's been resolved and they've finally agreed on something. It could cause a little pop in the pound. Over to the ECB. Villeroy said it would be desirable to reach the terminal interest rate by the summer, but it's too soon to say at what level, and that the ECB need to be pragmatic and guided by the data without fetishism for two mechanical rate increases. So doesn't want to be tied into how big and how many rate hikes they have to do and forecasting those in the future. That was a bit of a departure from Lagarde at the last ECB, pretty much prompting that they're going to get 3 interest rate hikes of at least 50 BPs, because they don't usually often give us that sort of information in advance. They don't like to pre-commit, was the historical line from them. Anyway, the ECB are going to remain at a terminal rate for as long as necessary, he says. Coming over to the US, and a lot of jobs data. One I missed actually yesterday, probably because I was late in this week for the holidays and whatnot. The Challenger Gray jobs numbers, these are the layoffs numbers. This is firms who potentially announce that they're looking to shed the workforce. It doesn't mean all those people will end up losing their jobs, but they announce a job cuts, like when you hear Amazon saying they're looking to lay off 17,000. It doesn't mean all those 17,000 are going to lose their jobs, but that's what they're looking at. And anyway, it fell 43% from November's numbers in the December reading, but it was up 129% on December last year. So we have seen a bit of a climb in job cuts coming in. There were 43,651 job cuts announced in December. And it's the highest fourth quarter of job cuts since Q4 2020. Now, we know the tech industry in particular has been announcing a lot of job cuts, so probably a lot of that is seen in these reports. But are they going to translate into actual job losses, and is it going to impact the job gains? I guess we'll see that later today with the NFP. And on that note, the ADP surprised yesterday with a pretty strong read at 235k versus 150k expected, and a prior November of 127k. So that's got the market maybe looking at the bullish side for the NFP number today, which is expected in at 200k for, let me check, 200k on the Reuters and 202k on Bloomberg. So those are the expectations for today. Market may be looking a little bit higher. It would be an apt time, wouldn't it, fellas, for the ADP to come up strong and the NFP to come out weak, wouldn't it?
Well, there's no real correlation, let's say, although there should be, but there's been so many times when one goes one way and the other one goes the other way. So I tend to kind of ignore as much as I can the ADP number.
Yeah, very much so. But you're right. You know, you can't draw a real correlation to it because it can be so funky. But the market still trades on it, and the market still changes expectations. It's the funny thing about it. What do you make of it, Kay?
Yeah, the market definitely traded on it, but the market really traded on the back of the combination, right, with the ISM and a couple of other data, which started really to weaken at the end of last year, and then coming out a bit stronger at this week. So, but it's still a yo-yo. If you look at the euro dollar, for instance, but okay, euro dollar is probably a different thing. It's where we were after the morning of day one of the year, back to the low 105s. The rest of the dollars has been doing well, but the market definitely traded it. The market is, as we have been saying as well for weeks, if not months, it's the last big domino. So as long as the market doesn't get negative numbers, there's not too many reasons to start to sell the dollar massively. But we never know. Yeah, I mean, after what happened this week, if you look around the dollar sphere, a bad number would probably have a bigger impact. Now, we'll talk a bit later about what's the definition of a bad number and a good number, because I mean, the 200k is just for the expectations for the NFP is still just a number that they fishing out of the air, I think. It could come in anywhere. As usual, we'll have to look at the combination of what's happening on the unemployment rate, participation, wages, and stuff. But as far as the actual number goes, we have to remind us that anything which is above 60, 70, 100K is job creation as we stand today. So even if it would come in at like 100,000, there may be an initial, if the rest is not like really bad, there may be an initial reaction to the other side of the dollar, and then perhaps the dollar gains back its power. But yeah, seeing the dollar buying this week, I'd say a real negative one will be a bit the surprise. It will be the surprise trade, but let's see how it comes out. First of all, I'm really open both ways. What's happening this afternoon.
Yeah. And just a reminder, if you want to have a punt at the NFP, you can join our competition. I've just put the link up to the tweet there. Pick a number, win a free month on the ForexAnalytix platform. Staying with the jobs data, and initial jobless claims came in much better than expected, 204K versus 225K expected, and continuing claims dropping under 1.7 million as well. I mentioned it, I think, yesterday, but it's for last week. So this may be impacted by this bad weather we had in the US. And as I repeat, it could impact the NFP next month. We have seen funky weather-related NFPs in previous times. And some of these storms have been pretty heavy. And if it stops people getting to jobs offices and the surveys being done, which are, I think, are usually done the middle of the month, on a week period, usually something between the 11th and 18th of the month, they take the numbers for the NFP. Might have missed a lot of the storm stuff for December, but it could impact January's numbers. So do keep that in the back of your mind, particularly for next month. Keep an eye on those jobless claims as well. If we see the next couple of weeks them dropping really significantly, could be that weather-related stuff coming into things, which will then maybe give a full sense of what's happening in the jobs market. Coming over to the Fed heads, Fed George favours rates above 5% and staying there for some time, and that the Fed will hold rates up until 2024. The risk to the economy rises when the Fed is hiking rates, and the recent inflation data shows welcoming signs of pressure easing. Fed's Bostic said inflation is the biggest headwind to the US economy, and there's much more work to do despite signs of prices moderating. The Fed is committed to using tools to lower inflation. Bully Bullard taking a modest start of a victory lap, let's call it, saying inflation is seen moderating in 2023, and Fed action with the prospect of more hikes is helping to dampen inflation. Contained inflation expectations are also moderating inflation pressures. But inflation is likely to ease slower than the markets expect. We were talking about this yesterday, weren't we, Stel, that, you know, you've been saying it, I was saying it last year, inflation is likely to moderate coming into this year, and they're all going to take their
Of course they are. Of course they are. I mean, to be fair, to be fair to the Fed, they have acted really fast. And they've done, no, let me put it this way. They had a delay. They should have acted earlier, but when they started, they went for it. So, you know, we have to give them that. And that is definitely pushing inflation lower. So, but that's not the main reason why we're going to see a lot lower inflation readings. You know, it's not the Fed, because at the end of the day, they are the ones that cause the inflation. So, you know, you set your house on fire and then you put it out and you go, yeah, I'm the hero. No, it doesn't work that way. Anyway, let's see. Interestingly, we saw, I was away for 2 minutes. I don't know if you discussed it. We saw Euro CPI today, which came in almost a percentage point lower than the last sprint. So that's also coming down. And we've said before that Eurozone inflation is going to be a little bit harder to bring down. You know, the energy cost is a huge aspect of that inflation print. And people look at the core CPI and they say, you know, the core is still doing well. Well, as energy goes down, because remember, core CPI is excluding food and energy and I think alcohol and tobacco. as energy price goes down, everything's going to go down, right? Everything that gets manufactured needs energy. So it's not like you take out the price of energy and food and you have a really clean number. Of course you don't. But you know, for me, the main takeaway is inflation is dropping relatively fast, and I think it's going to continue to do so.
Yeah, no, you're right. And I was going to mention that core number as well, because even though, as you say, the headline number dropped nearly a whole 100 basis points, the core went up 2 pips, and that is important for the ECB, because that's what they're looking at. It's central banks like to do the core headline switcheroony when it fits their narrative, and so they will be looking at that core number because it does lag the headline, but it is more domestically led, so it shows more where inflation is on the ground, obviously outside of wild energy moves. So that needs watching. If it keeps creeping up even while the headline's going down, that's going to keep the ECB on the hike path.
Yes, I agree 100%. Just to answer a question from our friend Anis, not sure if Fed created inflation or was fiscal policy during COVID with 5 trillion giveaway. Yeah, you're right about that, but let's not forget 13 years or 12 years, whatever it was, of zero rates and QE, which is supposed to be an extraordinary measure, which is supposed to be a short-term measure. It's supposed to be a year or so, or 2 maybe. And they went on for such a long time because, hey, let's face it, it suits everybody. So they are equally or more actually responsible, in my opinion, for the inflation that we saw. Anyway, carry on.
Yeah, we'll do, mate. Now, I've got a bit of I'm looking at dollar yen right now, and I'm looking at the dollar as well. And, you know, I'm thinking more and more that this move that we're seeing, particularly in dollar yen, is more yen led, and there's several reasons for that. I think that a lot of the market is washing out the overexcitement from the Bank of Japan, and then moving, you know, towards tightening when they've said that's not the case. Even with the expected jumps in inflation expectations, none of them are still up to the Bank of Japan's target, even out to fiscal year 2024. The dollar is strong against a lot of pairs, but it's not, you know, take cable out of the mix because it's always volatile. It's not really, you know, dumping anywhere. We're not seeing euro dollar crapping out really big. At the moment, it's holding this 105 line. Dollar yen's been on a bit of a moon shoot, and that's been quite surprising. But the key thing is it's not been following yields. You know, if we think that the dollar's going to go up on strong US data, that's all well and good. But when you look at yields, you know, they've never, in the last few months, they've never been shy to jump significantly on good data, or when it means the Fed may turn or keep hawkish or turn a bit more hawkish. And the fact that they still look subdued, you know, that takes a bit out, for me, out of the equation of whether this is a strong dollar move rather than a weaker yen move. And further to that, the rate expectations for the Fed, you might think that given this data, given the run up in dollar yen, given the bounce up in yields, or given the strength of the dollar per se, we're looking at big expectations for the Fed. Well, on the rate probabilities, we're pricing higher for a 25 pip hike than a 50 pip hike at the next FOMC. 56% probability of a 25, 44% for a 50. So there's all these little indications telling me that, you know, if this was purely on the dollar side and purely pricing the Fed, we'd have those expectations, those probabilities much higher. Yield would be much higher. We'd be creeping up to the maybe 3.8s and above on 10s. 2 years, yeah, they are looking a bit more bid on the yields, you know, up near that 4.5% mark, but we're still within this range that we've been watching in our rule of thumb. So, yeah, I'm not wholly a believer that this is purely dollar led and purely Fed expectations, because some of the signs I'm looking at are not showing that. What do you guys think of that?
I think you're painting a very, very complicated picture, trying to explain this yen move. I think it's a yen move. I think there's been some capitulation of the first 2 days of the year have been a bit murderous, right? We had this sharp move down under 130. I suspect a lot of stops have been triggered there, and then people getting back in the market being long yen. Now, waking up to the reality of the Bank of Japan, and even though the Japanese 10-year is hanging at that 50 BPs, Bank of Japan is buying JGBs every day again and across the curve. So they're showing what they're actually putting their money where their mouth is, saying that it was like an adjustment and the market functioning thing. And the market the market likes to overreact on everything. And even though I haven't traded it because it was one, so violent, two, not so sure about what the data were going to give for the dollar. But I really understand this move, that the market was trying to buy yen. It's supposed to be the trade of 2023. And usually what happens, you anticipate the trade of the year, and then you get it around your lederhosen, as I say, and dollar yen now going back up, and yen crosses going back up. So because if you can't attach this move to yields, because yields have been moving a lot towards the end of the year, and then they've been cooling down the first week of the year, especially the 10-year. Let's look at that, because that's where the Japanese companies look at most, or players or asset managers, money managers. But there's been a bit of a disconnection. So I think a lot of it is anticipation, reaction to the Bank of Japan, running a bit too hot in the positions probably, and that's what we've seen now, and combined to some dollar strength, market being likely short dollar yen, cross yen, whatever yen, and now needing to revise the positions a little bit. I think it's much more to do with that than really trying to find the trend or the real move right here and now. But I do think that if, for instance, we get a real let's look ahead a couple of hours. I do think that if you look at the yen, if we get a real good report again, then there's going to be a lot of thinking to be done and being done, I think, with the money managers or people, hedge funds who think the recessionists are going to have a bit of thinking to do, and I can see the dollar strengthen also versus the yen. And a good report should also spur people to put on some carry trades again, in my opinion, and typically that would weigh a little bit on the yen. Have we seen the bottom of the dollar yen? I don't know. On a real bad report, and I'm really saying a bad report. If you look at job creation 0 or negative, and you see a big jump in the unemployment, the yen is also going to react stronger, because likely yields are going to drop fast, and this time the correlation will be there, and cross yen will be sold, because that's when you talk about bad economic data, yen should really react. So, but for now, this move, I wouldn't overcomplicate it. I wouldn't really not overthink it.
Yeah, no, exactly right. You've sort of in another roundabout way said what I was saying, that it's not really a dollar move. It's not really a move on higher expectations for the Fed, because the little clues around are saying that's not the case. And I think it's important to point that out, because people might look at this and think, oh, this is all the dollar, because everyone talks about the dollar. But it's important that when you're trading, you try and find out exactly what wind is blowing. So even though on the face of it, it looks like this is pure dollar strength, that's not exactly the case, as both Kay and I have just explained. So it's important to know when you're trading which way the wind's blowing and what wind's blowing in which direction. Let's take a look at the upcoming NFP numbers then, just to give you an idea of what we're looking at and how to get set for it. I agree with Kay. You know, you could have expectations for what the market may do in the days and weeks leading up to it, but you have to look at where we're at come today. And as said, those ADP numbers have probably set the market looking maybe towards the upper side of expectations. Doesn't mean it's going for a moon shoot, but that's which way the market will be leaning. So the bigger price reaction may be if it's a poor number. I completely agree with Kay. If we're looking anything 50 to 100K as a low end number, that won't be too bad for the economy. Obviously, anything negative is going to hit the market hard. Look at the participation rate as well, obviously in line with the unemployment rate, 3.7% expected in the unemployment rate. Let me see if I can see any expectations for the participation rate. Let me have a quick look. Expected to tick up a point to 62.2. Now that can affect the unemployment rate. So if the participation rate rises, that means there's more people coming into the jobs market looking for jobs. It can cause the unemployment rate to go up. That is a sort of bit of an artificial number. So a good number is when the participation rate goes up and the unemployment rate goes down. So if we get a strong NFP, unemployment rate going down, participation rate up, that's a hat trick of good numbers. But conversely, any difference in that where maybe the unemployment rate rises, but the participation rate drops, that's like a double negative. Also keep an eye on the wages numbers. Where were they? Average hourly earnings looking to come in at 5%. They took, if I remember rightly, quite a bit of a jump over the last month or so. So keep an eye on that. Obviously trying to play catch up with inflation as well. If you get a strong read there, that could counter whatever happens in the headline payrolls numbers and unemployment. You know, if we get a non-farm payrolls of 50K or something, unemployment rate 3.8, but we get a jump in wages to 5.5%, 6%, that's going to counteract a lot of the negativity you see in the payrolls numbers. So as always, there's lots to look at for this, and you've got to take the headline number first, then look at all the different components before making a decision in nanoseconds what the trade is, such as a life of data. What are you looking at, guys? You got any assets in your crosshairs for this one?
You mean going into NFP?
Yeah, you're gonna be looking at anything in particular to trade?
Not really. I'm kind of hoping for a strong number to get a bit more risk off, and you know, I want to buy back the silver I sold at 24. I'm looking at 22.20. I've said that before. Oh, we're kind of halfway there, but I'm not really carrying much into the number, and I don't have that much running or looking at, unfortunately. Yeah. I don't know if Kay has anything, but I'm pretty quiet and boring at the moment.
How about you, mate?
No, well, yesterday I was a bit long dollars, and I covered it mainly through cable. I'm virtually the same. I'm still wearing, I'm still carrying my euro sterling, bit of long-term silver, but I also let a lot go in the last week of the year in the run-up to that 24.5. So I'm much lighter than I used to be, and really for now, that's the only thing I really got going. I mean, no, I'm very traveling very light because I still think he's going to be a big mover, or potentially a big mover. And I don't want to get caught on the wrong side of the street just by carrying something. No, so I'm really open to whatever the data will give us. Also, we have the Canadian employment number that could be very sporty for the people having Canadian dollar in position. So yeah, watch that closely, because we have seen huge moves in Canadian dollar when we get like double whammies on the reports, one side or the other. And so look, going into these, there's the dollar side of things, and then there's the cross side of things, because and I've put it on the in the chat room this morning. There is probably stuff to do on the crosses as well. If one doesn't want to really be engaged in too much too many dollars, there is stuff to do on the crosses perhaps. If you get a good report, in my opinion, the carry trades are going to continue to do very well. Stuff like perhaps yen lower versus quite a few currencies. Could see stuff like Euro CAD lower, a bit Euro Aussie perhaps correcting, and things like that. If you get a really bad report in turn, then you're going to see, and I think that they are going to walk hand in hand, is the yen and the euro are going to strengthen against everything. If you see a really bad report, right? Negative stuff. I mean, if you get a real big jump in the unemployment rate, or participation dropping massively, NFP being negative and stuff like that. But then I think risk is going to come under a lot of pressure, and you would see stuff that we have seen happening over the course of the first week. Like, for instance, Mexico is strengthening. The bank, and it's still a 10% currency. If we get a reasonably good report out of the US, I can see all the MEX crosses, the MEX continue to gain strength versus virtually everything. Perhaps apart from the dollar MEX may be just doing a bit of algo blips, but I reckon Mexico is going to be one of the beneficiaries if we get a good jobs report out of the US. That on the cross side, if it's a real bad one, then I think stuff like Euro Sterling, Euro Aussie, Sterling yen pairs in general will get a severe knock on the head initially.
Yeah, I'm thinking that the yen is the place to be for this one, for two reasons. Purely because we've seen this big move in yen pairs. Now, if it is because of what's happening in Japan and everything, that's something that's not going to get knocked too much or for too long on bad numbers. So, for example, dollar yen. If we do get a weak NFP number or a mildly soft number and dollar yen gets knocked and yen pairs get knocked, I think that's potentially maybe a dip to buy, because that would knock it out of the trend we've seen this week. And as long as the data isn't too damaging, the market's going to get back on that bandwagon pretty quickly. As Kay mentioned, we've got the Canadian jobs as well. So if you want to take the dollar out of the equation but still play the yen, if you get a strong Canada jobs number, that's going to see CAD yen run higher. If you get a weak one, it's going to knock it down a bit. And again, is that a trade you might want to think about getting on for a bit of a reversal and a fade back to what the trend was doing before those numbers? Yeah. So going to be lots of stuff to look at. And as Kay's always making the point, if you want to take dollar out of the question, look at the crosses. And I mentioned earlier this week, I think the crosses are going to be really important this trading year, particularly the early part of the trading year.
And also crosses are sometimes some of the moves will be smoothened because you don't have the dollar jump in the crosses, but they can also see less gaps. For instance, and take an example. We get a -50 NFP number. You will never sell dollar yen at 134. The first price could be 132.5. But if you look at some crosses, all the dollars are going to get hit. So for instance, I'm just taking an example. It's not something that I want people to trade or that I necessarily will trade. But for instance, cable will jump as well, 100 or 150 points. So you're going to have sterling yen, which might still be around, maybe not 159.5 where we are now, but like somewhere high 158s or so, because the dollar move will be similar for a starter in many currencies. But if the number is really bad, risk should get a knock on the head. So to take again the sterling yen, and again, it's not investment advice or trading advice even, but you could still get like high 158s and the thing plunges over the next hours or couple of days, goes another 1 or 2% lower. That sometimes crosses gives you an easier entry than per se the dollars, if you look at it from a risk point of view.
Yeah, well said, mate. Well said. Stel, you promised us some charts today. Are you up and running?
Well, I said I was going to wait for NFPs, but I can show a few
Are you going to
things.
wait? Oh,
No, it's okay. Don't worry. Don't worry. I can show a few
no, if you're not ready,
things.
mate. We can,
No, just put me on the spot. It's fine.
Harry Stelios.
Harry
Stelios
I'm
hindsight.
sure he promised
Harry
us charts.
Styles. Oh, come on.
Harry hindsight. And let's get the move first and show you the charts later. And I can throw the lines up there as well.
I got it. All right.
He's always
while you're putting up your charts, I just want to answer Charlie there in the Q&A. Okay, the first question, I think we've already been talking about it. But could you address why US data like PMI yesterday caused volatility outside of like sterling Kiwi? I think it's just purely liquidity issues, and there's no reason why sterling Kiwi would move on US PMIs. Really not. I mean, it could be a liquidity issue because in the Kiwi there's less liquidity than in stuff like cable, which is trading more actively. And for the rest, really, if you take exactly that example, like sterling Kiwi, there is absolutely zero reason why sterling Kiwi would move on a US PMI data.
Yeah, and there's the volatility in the pound. We're always talking about it on here. There's far more volatility in the pound and cable than there is in other pairs. Just an example, the 1 month at the money options vols that I look at, cable's trading at 11.5%, euro dollars trading at 9.5%. So, you know, there's a 2 percentage point difference in volatility there. Funny enough, dollar yen is trading at 14.5%. So that's even more volatile. Thank you, Mr. Greek.
Okay, I am not going to say anything new. I'm just going to give my my overall kind of medium-term, shorter and medium-term overview on what I expect to happen. So I always start with yields because let's face it, the Fed is driving pretty much everything at the moment, and the other central banks, but the Fed is has been ahead of the curve compared to the other banks, central banks, not obviously not compared to the economy and inflation and all that. But for me, I think the risk remains that the Fed will continue to be a little bit more hawkish than expected. Now they have been, but the market has been ignoring that. I think the risk is now getting bigger and bigger that the market kind of gives up, at least for a little bit, and believes them that they're gonna hike more than expected, and actually they're gonna hike a little bit more than expected, but they're gonna stay at that level for a lot longer than the market expects. Remember, the market expects 225 cuts by January, I think, or something like that. So I think that this is something that they have been telling us explicitly, that the market is kind of mispricing it, but the market doesn't care. So what I think is going to happen is I don't know what the trigger is going to be. It could be payrolls, could be inflation, could be anything in the short term. But I think we have one more push to the high, to the upside in yields towards this 4% zone. Maybe even could challenge the previous highs. So we could see something like that, and then I think we go a lot lower. And this is because I think, as I've said for a while, before inflation had started dropping, I said I think in late Q1 we're going to see inflation a lot lower, and it is getting there. It's getting there at the 1% chunks. We might see, I think we will see bigger drops than that. I know I sound crazy when I say it, but this is my base case scenario. I could be wrong, but this is what I believe. So I think we get one more spike in yields, which theoretically will go hand in hand with one more spike in the dollar and one more drop in equities. So the dollar, I think, could, well, look at this. We have this 200 DMA and 50 DMA crossing, which is not a good sign, right? This is a death cross. So I think we could challenge that. I mean, if we do get yields rising, we could even break higher. We could get towards this 108 level, but I think whatever move we get is going to be terminal. And same with equities. S&P, I think I've talked a lot about this. if we do get a move in higher in yields, I think we're going to definitely test these lows down here, 34.90, whatever that was. But you know, for me, the long-term target was always 33 to 34, which is the pre-COVID highs. And if what I think happens with yields in the dollar, I think we can all agree that a move towards down here is the most likely scenario. I would love to see this move because I really want to get positioned against it. I am looking at FX wise, I'm looking at some dollar pairs which I want to short. Dollar Norway is my favorite. Dollar Mex is another one. Dollar Norway has broken. So this is something that we had been looking at, and I think Blake it was, or I can't remember who it was, who said, you know, when we were breaking above this descending trend line, he said this is a really nice risk reward long, and look, it's done very well, and this is percentage wise, it's big, right? It's you know, it's not you know, the Norwegian kroner tends to move quite fast, quite quickly. So this is one of my favorites. I mean, ideally, I want to see this 1060-ish tested before I short it. But you know how it happens when the where's dollar mex? I don't have it here. When the dollar starts going, it's very, very difficult to go against it. So you got to have your levels, and you got to have you know, have a plan basically. So dollar mex, I think we could easily retest this 20 level, nice big round level, and you know, some moving average around there. This is something that I would really, really like to get short of because you get a nice carry as well. Cayman mentioned the MEX pairs. I think this is definitely something to look at. But my favorite one, you all know it, is silver. I got rid of half the position at 24-ish. Okay, went a little bit higher. We just touched this descending trend line. Funny how things trade so technically sometimes. I mean, it was almost to the pip. I am looking for a retreat towards this level around 22.20, 22.30. That's where I'm going to buy that half position back. But if we are seeing a big dollar move, I'm going to be a little bit more defensive. I might try to perhaps wait for the 21s. I don't know. We will see. I still have half my short from what was it, 2050 or something like that. So that's doing well. But like Cayman did, I like to protect my position. I like to take some profits when I can, especially if I think that the base scenario is the other way. People have asked me, you know, if you think the dollar is going to spike and this is going to go lower, why do you even have half the position? Well, for this thing in particular, I always want to have a position because this is something that I think one day is just going to explode, and I do not want to be left out of it. You know, I don't want to see the train leave the station and me having nothing. So I always have some position, and I job in and out of the rest. Gold, we've talked about gold extensively. Yeah, it's still trading well. You have to admit it's still trading well, but I can see a retrace if we do see yields rising, because we know the silly short-term reaction on rising yields is sell metals. I mean, rising yields because of inflation rising doesn't mean that gold price has to go down, but that's a different story. But this is the immediate reaction. So, you know, a move towards the 1780, maybe 1800. Yeah, I'm going to have a look at gold as well, but I'm much more interested in silver and potentially platinum as well. And I don't have to talk about cryptos. We've talked about them so many times. I mean, this consolidation is just still going, and it's still looking very, very heavy. So I would be very careful if I was long. You know where you're wrong. You're below these lows, but the question is, where do you get filled when your stop hits? So that's all I have. I repeat myself a lot, I know, but you know me, I'm not a day trader. I have a plan. I change my plan when things change, but at the moment, this is what I'm looking at.
Well, listen, what we'll do is, this is obviously recorded. I'll ask you to do the same next week, and we'll just play the recording.
Yeah, exactly. Well, today's numbers might change a lot.
Yeah. Quick question from Martin. Just talking about the NFP. If it's bad, say below 150k, US dollar yen should drop, i.e. to 132, and that would be a buy trigger. Did I get this correct? No, I think we're talking two things. A, volatility. So what Kay was talking about dropping to 132 is if there's a big miss in something when you're trading something like the dollar, is where you might get a big shift down because everyone's piling in compared to how the crosses may move. If you're talking about how to trade the numbers themselves, just to reiterate, we're looking at around 200,000. Okay, so if we get 200,000, it's going to be a pretty neutral report, obviously depending on what the other details are. If we get somewhere, if you're looking between maybe 150 and 250, that's going to be neutral. Between, you know, maybe 50k and 100k, that's going to put it on the soft side, but not wholly negative. Under 50k and a negative number, that's going to be the bigger shock to the market, and that's when you'll get the price move lower. 132, I don't know. That might be a bit of a stretch unless it's a really horrendous number. If it comes in minus 200k, yeah, we're probably going to see close to 132, that sort of thing. Would it be a buy trigger? Not necessarily, because it depends what the market wants to do with it. If it thinks that means the Fed is going to be forced not to get to their rate ceiling, it's going to see a big repricing in Fed expectations, big repricing in yields, and that might be a move that lasts a couple of sessions. So I wouldn't pile in just because the numbers moved it down there. Look at the price action. If it gets to 132, for example, and we spend a couple of days and can't get through 132, but we remain close, that's going to give you a bit of a signal that maybe 132 is a low, for example. But yeah, there's lots you have to factor into the NFP, all the details. So it's not a linear thing. Number comes in X, buy at such and such a price. But that's what you should be doing on your charts. You pick your levels, and when I trade something like the NFP, I'm not interested in levels that are 25, 50 pips away either side. I'm looking at the levels that are 100, 150 pips either side. Depending on what we get, those are my elastic band points where the price might stretch to and then pull up. But you can't make a decision until you've seen all the numbers and all the details. And if you're in the ForexAnalytix chat room, obviously you'll have my insight, Stell's insight, Kay's insight, Blake's insight as to what the number means. Are they really bad? Are they really good? Are they neutral? So yeah, that's what I'll say about that one. You say it's still a good carry to hold dollar yen. Question is what level? That's the question indeed. 129's the mid 129 is a good level, but if we get down there again, you could ask the question, why are we going down there? Everyone would like to buy it now, but would you like to buy it if we suddenly move down there again? That's what you got to do. You got to pick your levels on your charts where you'd like to get in. That's trading, irrespective of the data. Kay, did you want to have a quick look around?
I can. Let's make it quick, okay?
Yeah, tickling your fancy.
Yeah. Let's pick something that could be fancy. Here we go. All right, dollar yen. Just looking at the Q&A. No, nothing new.
Yeah, looking at dollar NOK. I hope I got your name pronounced right. If you want to have a look at that one at some point.
Yeah, dollar Norway is an interesting one. So dollar yen, important level here. Prior lows, prior high. We're turning around 134. I'm actually a little bit disappointed. It's trading here. I would have rather have it trade around here, so at least we can see where possible targets are. But it's really against the resistance. You can stretch it up to 134.85 perhaps. 90, call it 135 figure. If that goes on a really good report, I think there is going to be some people not liking it much, because the market, I think, is still overall perhaps positioned a bit long yen. So if we start to get above 135 and hold 134.5 on a close, there may be some more dollar yen buying to be done early next week. On the other side, 133s, low 133s, 132.85 ish. This 30-point zone here, 132.85, 133.15 should be a first level where we may be trading around on lesser report, let's call it sub 100K, but not a negative one. If really the report is really bad, and I think then there's a chance this dollar yen challenges 131.5 again, and then see what happens if it drops below. But expecting this one to be a volatile one, just because of the volatility, just because of people watching so closely the Bank of Japan and whatever they may do further. And then to further reply on what Martin said, I mean, 150, say below 150. 150 is not even the benchmark, in my opinion. The benchmark is really 100 and or even 70 or 80K. If we get 100, that's just my personal view, right? If we get 100K, we could see the initial reaction in pairs like dollar yen, the volatile ones, cable. Well, everything should move a bit against the dollar, but then remains the question is what are the rest of the indicators doing? So to me, 100 is just a number, but it's not necessarily a bad one. Let's put it that way. Or well, not a lasting bad one. Now, there's one here, the cable. And I've always highlighted this, and I've been highlighting this 117.40.60 for, I think it must be like, yeah, really over a year or so. And this really is an area where I really, if you look at how this thing has always been picking a direction every time we get into the 117.40.60 zone on the cable, and that's again an area that I'm going to monitor in case we get a really good report. We're not that far. We're only about 100 points away in cable. That's an algo move on a report, right? So watch that. I'd say watch it very closely what it does in cable around here. If we get a move below and stay below, we could see moves back down to mid 116s here for a starter, and why not a bit lower? But let's get the numbers out first. Top side, we need to get back above 123/4 really, and then the 121.1040 zone is always is one that has been played a role of late. So that is my zone that I'm going to watch top sides here. So two levels, about 123/4-ish, and then the 121.1040. Get above, stay above, and we could continue to push through. Another one, euro dollar is so much less clear to me, but 104.5 is really where it plays ball or not. If we get a move down there, 104.5 holds, we can get back higher. It doesn't hold, and then we're probably going to see low 103s again. And then, as I was already saying a couple of times, this big, it's anywhere between 108.15 and now the red line coming from 2017, I think, is already up in the high 108s. This is really my big euro dollar zone for me, where it's going to be deciding what is going to be for the medium or the longer term. Are we going to get a move today? It's going to happen up there. It's going to have to be a really bad one to see a move up there in the euro dollar, I think. But all in all, the euro to me is right now, since the ECB is more on the hawkish path, I think the euro is more of a cross play than versus the dollar really play. And people know what I mean at already for a good while. Euro sterling. I'm not going to say that euro sterling is going to be a big mover this afternoon, but it could. We have now broken above the year-end box. Yesterday, the retest overnight actually. We got the retest and we're holding above. This is encouraging. And I think it's got the potential to go further, as I was saying, on a bad US report this afternoon. It should not have a lot to do with the euro sterling, but euro usually picks up a bit of steam through crosses on rather negative economic data. So Have a look at it. If it really comes out of whack this afternoon, this euro sterling, in my opinion, could push through to the 89s finally. And then the yen pairs, of course. Look at this Aussie yen. It's broken below, retested it around 90.90, held, came back down, and now we are back there. The big trend is line comes in around 91. That's where are we? Where's the Aussie yen? It's not far, I think, right? Yeah, it's 90 and a half. So keep an eye on 91, I'd say, in Aussie yen. If it goes back above that level, also prior lows, there could be some more room, and that in case of a good report. All right, if you take risk, you need to just look at if the report is good or bad to trade yen pairs, non-dollar pairs. I'd say Aussie dollar. Bit of a support here, 67 and 20 at 67 and a quarter. We're 20 points above. If the report is really good, this Aussie could test below. The big level of no return, I think, for the Aussie now is anywhere between 66.55 and 66.75. I'm not really inclined to trade Aussie too much, I must say. But then, quick look at that dollar NOK, right? It's really broken above. It's broken above two trend lines. The other one has already been broken somewhere in the around the high 980s, but it's broken above this one as well, which comes back from the 11s, and it's looking big still. Look at what Brent is doing, but both Brent and WTI are a bit under pressure right now. I think that any move back down towards low 10s could find buyers, and perhaps for two reasons. Because if you get a bad report, the dollar will get a knock on the head initially, but then as well, if you look at the commodities, if you get bad reports, so out of the US, for instance, it should not be supportive commodities, not be supportive oil somewhere, because you got a bad economic report, right? So I think this one, if you get a knee-jerk reaction or a dump on negative, but not disastrous for the dollar, I think we are going to find bids here close to 10 right now. And if you get another negative number, I think Euro NOK may be reaching for the cloud still. Why not move back above 11 at some stage, especially with Brent, with the euro doing a bit better, with the gas prices and energy prices in Europe coming up relatively fast. This one could still be a good play. Give me a retracement down to 1060s, I may try to catch a knife. And then last little thing that I was looking at, that the dollar mix is still in the broad descending channel, where we have broken back again sub those. Where's my line gone? 1940s. Yeah, why did I kill this one? Anyway, sub those 1940s. We have this short-term flag that we retested in, and we're trading down. I think if we end the day sub 1925-27, it could go lower. But I'm rather looking, as usual, to mix crosses, and the euro mix is really on an interesting level here. Again, we've broken sub 2040 without too much of a difficulty, but we're back in a bit of support zone here in the 2027-2025 zone. So keep an eye on that one. And as I said, good reports will encourage carry trades. Okay, and I still think that there's perhaps a bit of legs in the Mexican peso. And if you would really have a good report, look at the Mex yen, which had a big correction at the end of the year, like all the yen pairs corrected, but is now trying to get back to get some steam back today, and it's a pretty simple level 7. If you think the report is good enough, and if it would break above 7, makes yen could start to go higher again. On the bottom side, 678, 6.75. I think the level of no return here is 650. That's pretty clear now. Bear in mind, those are relatively big moves, because you're talking about 6 something. If you get a move from 695 down to 660, you're looking at a 5% move, right? So be careful with what you do in these carry pairs, especially when you're talking about MEX, yen, and something. But you're still looking at a 10% currency, 10% interest rate in one currency, and the other is still max 0.5%. So if the report is good, and don't jump into any too early conclusions, right? But if the report is good, I think carry trades will still continue to do well. And with that, back to you, Ryan.
Thank you very much, mate. Right, so that's pretty much near the end of the show. Just to summarise, it is a big number. It is an exciting number. When I was on the live floor, it was the most exciting number of the month. Everyone packed in the pits. Don't gamble on it. Don't think this number is going to be X, Y, Z and put your money there. If you want to gamble, go to a casino. If you do your arse, at least you get a free drink at the end of it. Look at what the markets are doing going in. You know, does a 5-minute data report change what a price has been doing all week? That's the question you got to ask. Those are the opportunities that will bring you the better rewards. So if you want to get the best of it all, then don't forget you can join us on the ForexAnalytix platform. Follow that link there, give you some details, and you can grab a Forex Flow exclusive 20% discount. So please trade safe for the rest of the day, over the weekend. Have a good weekend, safe weekend. Thank you as always to Kate and Stel for their input, and thank you all for coming to the Flow Show and making this all worthwhile. Trade safe, have a great weekend. Thank you very much.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.